Welcome, everyone. I can't see you, but I'm Leslie Jouflas, and I'm the founder of Trading Live Online. I've been in the markets for over 25 years, trading and teaching. My website, Trading Live Online, was established in 2007 for the sole purpose of helping traders learn how to trade. It's not always an easy thing to do, but I think my materials help traders formulate a path with trading plans and get on the right road to success. I'm going to show you today some tips and tricks with Fibonacci ratios. And I'm going to show you something that I call backward fibs. I'm going to show you the importance of the 0.886 ratio. This is what I call the last chance fib. And I'm also going to show you the important Fibonacci extension ratios. And these are important to learn because they can be used as trading setups, and they can also help traders with trade management. Now, if you like the type of work that you see here that I do, I've got a book, Trade What You See, How to Profit from Pattern Recognition. I wrote that with Larry Pesavento. Some of you may know who he is. He's the one that really brought a structure to some of the patterns that I'm going to show you. And he really helped bring Fibonacci ratios to the forefront and make it a household term and something that is quite common now. When I started with Fibonacci ratios, many years ago, they were really not considered to be um, really valid in the world of technical analysis. And they were still looked at as if they were tea leaves in a teacup, which you'll see with this presentation that they certainly are not. But they're standard now in every trading platform software out there. And even a lot of the professionals that used to sort of turn their nose up at fib ratios are also using them. Now, I want to show you that my email is right here. So if you have any questions about today's presentation or the course that I'm going to show you, please feel free to email me. Okay, so let's get started. I want to, first of all, kind of cover that trading and learning to trade is just not one skill set. It requires many skill sets. So if you are watching today and listening to a lot of presenters, the first thing is you've got to decide on one thing to study. So try not to be out there everywhere. Find something that really resonates with you. I listed out just sort of a few of the skill sets that are needed to become very, very proficient at in order to trade successfully. You've got to decide your method, the approach that you're using. Are you using technical or fundamental, maybe a combination? Are you a discretionary trader or mechanical trader? I'm a discretionary trader, but I've tested everything that I trade. So it's a mechanical system that I apply in a discretionary method. Technical analysis skills. I'm a CMT, I'm a chartered market technician. I have a lot of experience with technical analysis, and I do combine classical technical analysis with what I do. This is a very broad skill. You have to have a skill of your routine, knowing market environments that you're trading. Each market has a little bit different personality with time frames, different skill sets needed for different time frames, uh, trading plans, risk management, execution skills. This accounts for your bottom line. And so you've got to have all these things built before you can even get here. How do you handle mindset skills, handling drawdown periods, periods of large winning streaks? That's a mindset skill because traders can tip over into a euphoric state, trading errors. So anyway, so just kind of keep that in mind as we go along today of all of these different skill sets. So let's move on to the next slide and get started with a little bit of history of Fibonacci ratios. And what are they and where did they come from? They didn't really come from anywhere because they're inherent in just about everything in our lives. Pythagoras lived way long time ago, centuries and centuries ago, 570 to 495 BC. He was considered to be the father of modern geometry. And he and his students, they believed that numbers and proportion were harmonic and that everything is related through mathematics. And that this belief in proportion and harmony is linked throughout history to what's referred to as the golden mean, which we're going to look at today with our fib ratios. But they were, unfortunately, at the time, they were limited in proving their theories because the mathematical system that they were using had not yet been discovered and was not in use. And interesting, Pythagoras's wife, she also led an inner circle. These were mathematicians and who studied these principles. And she is also credited with writing a treatise on the principle of the golden mean. So that's really interesting that a woman back then was so prominent with this. And it's also believed that Pythagoras may have discovered the golden ratio through sound, creating a harmonic pitch. We're going to look at a slide a little bit later that relates to that. So Leonardo da Pisa, a lot of people think that the word Fibonacci is the name of the person who really brought us those ratios, but that's not the case. Leonardo da Pisa is the mathematician who, through a book that he published, a book of calculations in 1202, this book introduced to us the use of our numerals 1, 2, 3 versus the Roman numerals. And so when you hear the term Fibonacci and you hear someone say, call it by that was his name was Leonardo da Pisa. He was from Pisa. Now, it's quite possible that he may have been, that the name Fibonacci was attributed to him much later, possibly by Lucas, another mathematician. He kind of rediscovered the Fibonacci sequence in the late 19th century. So it's still not completely known. There's just some speculation on that. Now, the golden mean, that you probably heard this term, is known by different names: the golden section, Leonardo da Vinci, divine proportion, Pacioli, and then also the Greek sculptor Phidias. He also used the ratios in the Parthenon building that sits atop the Acropolis in Greece. Now, here a couple of the terms here. There's the symbols there. The capital PHA for the 1.618, that is pronounced phi, and the smaller case reciprocal is pronounced phi. So just in case you're curious. Now, the Fibonacci sequence, this is what it is. It's actually pretty simple. It's each number is the sum of the two preceding numbers. So here's an example here. So this is how it goes. This is what the Fibonacci ratio series looks like, and this goes into infinity. So if you really have nothing to do one day, you can just sort of keep going with this and see how far you can get. But you start with 0 plus 1 equals 1, and then you go to the next. 1 plus 1 equals 2. You take 2 plus 1 equals 3. 3 plus 2 equals 5, and so on, and so on, and so on into infinity. Now, where it gets very interesting is after the 8th sequence. I go back, just go back the slide. Here's the 8th sequence here. If you take any two numbers and divide the smaller number into the larger number, this is where you get the 0.618. Now, prior to the 8th sequence, it's very close to this, but once you get to that 8th sequence, this is where the 0.618 repeats and repeats and repeats. And so here's a couple of examples here. These are numbers that were in the sequence and divided 0.618, another example here. So you can take any two numbers in that sequence like this and divide, and you're going to get the 0.618, the golden mean ratio. And conversely, to find the 1.618, this is a really important ratio in trading, especially. You want to divide the larger number into the smaller number. So here's a couple of examples there. So a lot of these slides are actually excerpt from a course on this subject. Okay, so now let's get into a little bit about the proportions. These proportions are important in technical analysis. They're important in the structure of a couple of these patterns that are structured with Fibonacci ratios I'm going to show you today. And so we look at this example here. The AB represents the whole of this line. Now the ratio of AB to AC will be the same as the ratio of AC to CB. So we're going to look at these. I just want you to look at the proportions here from A to C and C to B, and we're going to look at how these show up in actually quite a few different things and also in the financial markets. So you've probably seen images of Leonardo da Vinci's Last Supper painting before, but if we add these ratios and these proportions, you're going to see them appear right here in this famous painting. It contains the golden ratio in several places in this painting. So if we take a look at the Great Pyramids of Giza, and it was thought that Leonardo da Pisa did go and study the proportions of the pyramids. And so that was interesting as well, that he knew about those ratios. But if we start to add, oops, sorry, those little people down there just kind of got wiped out by my lines. This pyramid took about 27 years to build. They're just now starting to really figure out, how how it was done. But when Leonardo da Pisa studied the mathematical relationship of the pyramids, 0.618 is relationship of the height to half of its base, and that equals 0.618. So you see this length here and this length here, and then here's our A to C and B grid. Also in music, there's a relationship of Fibonacci ratios, not only in music itself, but in instruments such as this violin up here. The musical scales are based on Fibonacci numbers. So it's, oops, excuse me, I'm trying to get to my next slide. This slide was sent to me by a student of mine quite a long time ago, and he was an engineer with NASA. And the Hubble telescope was still being built at that time. And he had told me that the lens of the Hubble telescope, Fibonacci ratios, the 1.618 was used in constructing it. And I believe in the Webb telescope that now is sending back the most fantastic photos of space, or also were constructed with Fibonacci ratios. So we know that they are present and they are used in many different applications, and they are in the financial markets, and they have harmony and proportion with the swings, and we can measure these swings that are all related with Fibonacci ratios. Now, actually, this is not, the next section is not harmonics. This is a slide taken from my course. So I just put it in here to illustrate the harmonics of swings and the repetition. You can see the upswings, very similar, down swings, very similar. And these are what we can use as a structure to trading patterns and trading setups and apply Fibonacci ratios to them to help us with those structures. Now, here is just a graphic of the Fibonacci ladder that I use in my trading. And I generally have these ratios on 0.382, yeah, the halfway mark, 0.618, 0.786, 0.886. We're going to talk about this one because this is what I call the last chance fib ratio. I'm going to give you some tips on that one. And there's also the ratio that's in between the 0.618 and the extensions 127 and 1618. And that is the 0.707 and the extension 1.414. I generally don't keep those on my ladder because I know that they're in between that. And if I see a price or a pattern that's completing or coming into this area, I just know that that's what the ratio is. Now, if you're not familiar with the extension 127 and 1.618, the 1.27 is the square root of 1.618. Not that that's going to make a huge difference to you, but this ratio, this is very common in many swings. And this ratio itself and the 1.618, these can be used as trading setups. They can be part of other trading pattern setups. These are the markets are constantly in a phase of either contracting or expanding. They only go up, go down, go sideways. That's it. That's all that they do. So in expansion phases, the 127 and 1618 become very important. So these I want to present to you today, and I'll show you some tips and tricks with that as well. Now, the last chance, the 886 retracement, this is not not that common, but it might be if I do enough of these presentations. But this is the last chance fib ratio. A lot of traders are looking at the 0.786 and they're looking at the 1.0. So we have the entire length of the swing. Here's so that we're referring to that as 1.0. So they're looking at this 786 or the 1.0. And so they're assuming if a price exceeds that 786, that the price may be continuing to the upside or the downside. But this 886 ratio very often is going to be a resistance or support area, depending on the direction of it. And there's, again, I'll show you on some charts, some tips and tricks with that 886 ratio. But what I did here was the proportions that we looked at just a couple of minutes ago, the A, the C, and the B, I added, so here's where we can see the proportion of the space with that. So I added on the 127 and the 1618, and I just extended this Fibonacci ladder. I just did it horizontally instead of vertically, so we can get an idea of the proportion of that space. So now let's look at a couple of things here. So when when price comes down, exceeds the 786, and say holds support at the 0.886. Here's something to remember about this. Very often the price will turn, maybe rally if it's at support, or it'll decline if it's at resistance area. But if the market starts to close below this 0.886, there's a very high chance that the price is going to get at least to the 1.0, and very often will continue to one of the extension ratios, the 127 or the 1618. So you might want to start looking at that 0.886 ratio as well. Okay, now here's what retracement, Fibonacci retracements look like with price added onto it. And it's important to start to observe how price reacts around the Fibonacci levels and the retracements. There's other tips and tricks that you can use. I'm going to show you this in the backward fib levels in just a few minutes. But a lot of technical analysis is learning how to observe price behavior in different types of market environments, expanding or contracting. Your expansion is your trending markets, and your contraction is your ranging types of markets. So let's move on now, and let's take a look at now some structure with these Fibonacci ratios that we can build into actual trading patterns. And these trading patterns, they are in all markets and all time frames. So once you learn the structure and the ratios with that, then whatever you trade, if you're an intraday trader, daily, weekly, monthly, you can apply this to any time frame. The shorter the time frame, the more frequent these patterns will appear. So let's kind of take a look at these. So the price charts that we just looked at, you can see there's different swings in the market. So we have maybe a leg coming to the upside, and that swing from low to high is broken by a retracement level. So here with this particular pattern, the 382 down to the 886 is considered a valid retracement for that second B to C leg. Now, sometimes it can even come down to where the 1.0 is, but that, I think, from a technical analysis viewpoint, has to be looked at the time, because that could also be a double bottom or a double top. So you sometimes have to apply some other technical tools to be able to sort of read the market if that occurs. But we don't want to see that C point exceed the starting point of the pattern. Same with if it's a buy pattern. So it's a lightning bolt shape. So you don't want to see that C point exceed the A. The A is always the starting point of the pattern. Now these patterns, I've got this D. The D is the completion point, and I've got 3 levels marked. So the A, B, C, D, this is the 1.0. That's where those 2 legs are equal. And the C to D at the 127, this is where we're getting some extension on it. It's extending. The CD leg is the 1.27 of the length of AB. It's not that hard to figure out. If you have, say, a 10-point swing on AB, you multiply that by 1.27, that'd be 12.7. You add that to the low of the C, and that gives you where that completion point is. And same with the 1.618. Now, what is a big asset for traders with these patterns is you can identify the formation of these patterns, the potential for these patterns as that C leg starts to turn up or down, and you can monitor it and know well in advance where these completion points may be and be setting up your trade with your risk management, etc. So here's a little more structure. Now we can add some more Fibonacci ratios to this structure. So here's our lightning bolt shape of ABCD. And so on the retracement leg, we'll have, again, from that 0.382 to the 0.886, maybe the 1.0, depending on market conditions. And then we have an extension. If we take the length of the B to C, that's going to be longer, this B to C length, if it gets below B, and that's going to be a ratio probably of 1.618, 1.27, and 1.414 that we looked at. So being able to very easily find out where that C to D leg might be completing, we can also use this fib ratio to see if we have some confluence with that completion point. And then as technical analysts, we can also look at some other things to see if we can find more confluence, not just with fib ratios, but with other technical analysis tools. So here's just a couple of, rules that I mentioned for these patterns. So you get a recording of this so you can come back and study this. Now, we call it AB equals CD, but not all the time. So as I mentioned, there's extensions of this. So only about 40% of the time are these ABCDs actually equal and complete right at that 1.0. A higher percentage of time, the pattern, the CD leg will extend to that 127. Now, here's how I learned the 127. When I learned these patterns, I really was only using ABCD equal to 1.0. So I place a stop somewhere around here and get stopped out and the market would turn. I buy here, place a stop here, because remember, I didn't have these on at the time. Place a stop here, thinking I'm putting it out of the way, get stopped out, and the market turns up. Well, after that happened, you don't have to tell me more than 40, 50 times something's happening. That's when that 1-to-7 ratio and the 1-6-1-8 really became a staple for me in these patterns and how I use them. And these can also help us with, again, the trade management with entries, exits, stop losses, etc. Okay, so now there's also uh, some variations of this with the legs not being perfectly symmetrical in length. And then there's also some other things with slope and angles, but we're not going to be able to really get through that today. But I do hope you guys will consider this course because it's an extremely full course for you to learn all this. So here's just an example of the extensions of that. So now let's look at that and see what it looks like on a price chart. So just using a Forex chart as an example, we have the A is the start of the swing, which is here. So we have A to B, the market makes a swing to the downside, and then here's the retracement level. So this retracement was 0.50, and then the market continues to the downside, and you can see our A, B, C, D, this is where they're equal. Right here, we have a 1-6-1-8 extension of that BC leg. We know we've got a couple ratios coming in here. There's probably quite a bit more in the price history that we can line up with our technical analysis skills to also help us with this area. And you can see the market turned and rallied from there. This chart, I just actually put this in this morning. I just kind of was looking at some charts, and if you can imagine, I probably should have done this, but if you can imagine not having any of this structure on here, and you're just looking at this big swing down, it looks like big choppy area. How in the world can you trade that? It's very tradable because this happens all the time. If we put some structure, proportion, harmony to the markets with our fib ratios and some basic pattern structure, A, B, C, D, lightning bolt shape, uh, this creates very usable trading setups that you can quantify your risk area, and also using tools like the Fibonacci retracements and extensions, you can also calculate your risk reward, potential profit taking areas with it. So let's just kind of walk through this. This is a chart of the S&P. This is an intraday chart, just as example. So, I mean, this could be a daily chart on something, a weekly chart. Again, these patterns are going to form on all those time frames. So we have this swing high here. And so here's where the low of the swing is. It's not here because this price is a little bit lower. So this is where you would want to start with the ABCD pattern. But if you notice right here and up to this swing, here's a retracement, and up, here's an ABCD cell that did a retracement. So that becomes part of a larger pattern that's forming. And within the B to C leg, there's A, a B, a C, and a D buy pattern. That's called a Gartley buy pattern because it's retesting that previous low right here. So number of patterns happening. And then as the market turns up from the buy pattern, it then forms the larger A, B, C, D sell pattern that has a confluence of numbers with a 0.50 retracement from the swing high to the low and up. It also has the extension of the B to C. Now, my software is actually, if the 1618 is just a little bit off one side or the other, it's going to give me exactly what that is. But that's just a smidgen off 1.6118. So we round it, call it 1.618. And so we have a ratio. So we have this ratio of the 5.0. We have the ABCD completion point. We have the 1618 of the B to C. And if we use this previous swing high to low, we also have a 127. So we have quite a few areas of confluence coming into this pattern completion area. So if we again I wish I would have done that, so I apologize. But if there was nothing on this chart, this would just look like a big mess. But we can add structure and we can find trading setups with this fairly easily with these kind of simple structures. Now we see the market here, it hits that resistance and it declines, does about a 0.618 retracement from A to D. So profit taking, you can design a trading plan using retracements. And then it forms another A, B, C, D, another sell pattern, retesting that 0.50 level, that 127 level, and then gets another decline from there. Here's another A, B, C, D. So this is the S&P. The S&P is really a great trading market for these patterns, especially if you're an intraday trader. These form on a regular basis. I think that this time frame intraday, I think this is one of the tick charts. I use several tick charts because they tend to show these swings very clearly. And then I also will use regular bar charts without Globex on them so that I can see areas of gaps and things like that for support and resistance. So I combine those things together. Okay, so let's look now. So I told you about backward Fibonacci retracements. Backward fib levels is what I like to call them. And I noticed these over years and years of studying and observing price behavior, and notice that when Fibonacci levels that are support that become broken, very often those levels will be retested. And it's, of course, the what was once support is now resistance. What was once resistance is now support theory. And it works using the Fibonacci ratios. And especially if you can create a Fibonacci ladder like what I have here, I keep these on. And so I can see those levels and I can monitor the price with it. So let's sort of take a look at this chart and kind of walk through it. So what we want to see for identifying a backward fib level, there should be a strong preceding move with some momentum in the direction. So in this case, the direction is down. We can see some long bars starting to form here. And the Fibonacci levels on the retracement are being broken. So you can see that broken on that 382. This did not really hold as support. It came down to the support, found support here, but it didn't really go anywhere from there. And then a long bar breaking through that support. Using these ladders also in this way can help you identify momentum in one direction or the other without even putting any indicators. There's a lot you can learn with technical analysis just using your eyeballs. And I'm a big proponent of learning the technical analysis like this first with those structures before adding any indicators. My rule with indicators is you have to know any indicator that you have on your chart. You must be able to define how that indicator either helps you make more money, more profits, or it helps you reduce your losses. And so if you can't define those things with any indicators you have on your chart, either you need to take them off, start with one indicator at a time, and be able to define that. Otherwise, it's just things on your chart that are probably cluttering things up. Okay, so now let's look at an example here of a backward Fibonacci level and see if we have those things present on this chart. So there's a swing from low to high. And so the market starts to do a retracement. It hits the 0.382 and it gets, notice how it doesn't get a really strong movement back up from that 0.382. That can be a clue. When you have a strong move in one direction, such as, let's say this was a strong uptrend to the upside, now you're doing a retracement. The retracement only come to maybe the 382, maybe the 0.50 if there's a lot of underlying strength in the market. If the market's not able to do that and starts to do deeper retracements, or it's not holding that first 382 level, then that previous move might be very suspect. So we have a preceding strong move and we have a break of the Fibonacci support level. So once it got here and it just did this sort of back and forth, created a range, and then look at the break of that. Look at those long bars coming down. Now that's showing us there's momentum to the downside. It just kind of gets a little past the 0.50, and here's the backward fib retracement right here. So where I've got this bold line marked, you can see the retest of not only the broken range, but the broken fib level. So there may or may not be something else combined with that level, such as a nice range that you can see like this. You might have had just a move just down with these kind of long bars and then a retest back up. This certainly helps, but it can work either way. Keep in mind, the main thing to remember is that you want a strong preceding move, and then you see the break of that level, and then a retest, because this can set up, many times you'll see an A, B, C, D pattern, or it's a retracement pattern. We can take a retracement from this high to low, and that's at just about the 0.50 of this swing. And even in candle theory, this is coming back into these long downward candles. This is heavy resistance in Japanese candlestick theory. Okay, so here's what you want to look for with those. So let's look at, I've got some more charts to look at here. So this chart on my weekly market setups, which is a subscription where I do this type of analysis every week. We're looking for different setups, show you setups. I walk through, I teach you a lot of this technical analysis in the weekly market setups. Here we were following Disney. Here's a 3-drive pattern. You see how the market made this 1, 2, whoops, let me go back, wrong one. I went to the 1, 2, 3 drives. That's also a little A, a B, a C, and a D pattern with that 3-drive pattern. And these, the 1 and the 2 is separated with a 127 extension, and the 2 and the 3 is separated with the 127 extension pattern. So there's, warning there that the market is turning. Now, 3 drive patterns can either be reversal patterns, or they can be a pause in a trend. In this case, it was reversal pattern. And you can see here that market declined and then went into a range. We have up, we have down, we have sideways. That's it. That's all the markets do. And from there, you get a lot of patterns in the ranging A, B, C, D buy, a retracement up, another A, B, C, D buy. This is actually a butterfly buy. And then retracement up, but that's also 127 extension here, retracement from the 3rd drive up, about 5.50, another ABCD sell, test the trend line, ABCD sell. This time we're breaking that trend line, and price is breaking the trend line. You can see this gap up. It just is not able to go any further, breaks this. And so here's an example, backwards fib, comes down, completely breaks, doesn't even pass go, breaks that 382, A, B, C, D, sell pattern, back into that level and continues down. Down here recently, back in July, Disney formed an ABCD buy pattern. This is a butterfly pattern because this ABCD extends beyond that previous swing. And we'll look at example right here of that with the ratios on it. This symbol is FNKL. One of my students actually brought this symbol to my attention. And again, market up, market down, sideways, up, down. That's all it does. So if you learn with your technical analysis skills, and I can help teach you with that, especially with our weekly market setups and the courses, how to identify, when you're in a range, when you're signs that you're going to be coming out of that range are very important. When you come out of ranges, you generally are going into trending types of moves. So it's very important to know the environment that you're trading. But over here, we have an A, B, C, and a very extended D leg. Here's a long, wide-ranging bar. That was a clue that is going to be getting the extension up here. We have from this high to low, the 127 extension there, and the market reverses. I think there was a lot of enthusiasm, a lot of very bullish sentiment on Disney back here. But there was the big butterfly sell pattern. It's actually almost another ABCD right here. And then steep decline to the down, or not Disney, excuse me, on FNKO. And then over here, after another rally up to about the same price level, another butterfly sell pattern. So here's the A, B, C, D. You see how the D is extending beyond that previous swing. That's what makes it the butterfly. These can be very powerful reversal patterns. So American Express, earlier this year, late last year, American Express started forming as a lot of stocks were forming these butterfly patterns. Financials were forming them. The indexes were forming them. When you start to see consecutive patterns like this form, take that as a warning that something is happening in the markets, and you may be getting close to an important turning point in the market. You can see how the extensions from the X to A and to the completion of these patterns form. This one was 1.4, this one 127, but they form a trend line, a natural trend line. Larry Pesavento pointed that out to me, years and years ago when I studied with him. Again, a lot of enthusiasm in the markets right around this time, end of last year, beginning of this year. And you can see the severe move to the downside from these butterfly reversal patterns, found support at the 1.4. So now let's take a look at the SPX from late last year, early this year. And I was, charting these patterns as they were forming. So it was on my weekly market setups. I do segments for your daily 5 for StockCharts.com, and was pointing these out, but nobody paid attention because there was just a lot of enthusiasm in the market, which is generally the case at market highs. But again, almost really nice ratios on this pattern. So you have the swing here down, start your A, B, C, your retracement leg, and then your C to D extension above that X point. Now you might be saying, but Leslie, isn't this a B, C, D buy? Well, yes, we could put that as a B, C, D buy, but look at what we have before it. We have this butterfly pattern. We can draw this trend line in. You can see a test of this trend line. Retracement from all-time highs is not able to make it up to another all-time high. Long, wide-ranging bars breaking a trend line. That would definitely be a warning sign that traders may not want to be trading that. They probably want to be going in the direction of that butterfly pattern. And so here we have retracements back up to the trend line. This would be a Fibonacci, a backwards fib level as well. And then as time went on, several months into this decline, it forms a big ABCD buy pattern. Here's the D 1.0, the first completion, gets a pretty good rally off of that. It then turns, declines again, to find support right around that 1.27, then forms a Gartley ABCD buy pattern. All right, here, rallied up to just about that 0.707. We take the swing high to low, and it's also a 127, so resistance there. And using other technical analysis tools, we could find other means of resistance in this price level as well. So recently, the last few days, we've been rallying. This was a 618 retracement, low, high, 0.618 right here. So now we've been rallying off here. So we'll see how far this rally can get. Intraday charts were showing little buy patterns down around these lows. Okay, so there's a lot of information for you in a short amount of time. I'm sure some of your heads are spinning, but don't worry, you can watch the the videos back. And I do hope you're going to take advantage of this course that I'm going to show you in just a second. Just want to also show you a few comments from some students of mine that have taken this course all the way through the 12 hours. And some have gone on to do like some one-on-one mentoring, coaching with me, which I'm always happy to do with traders. This guy here, he had been using harmonic patterns for a long time, but the course really added to his knowledge of the trading patterns. So I was very happy to see that statement, because that's absolutely my goal, is to help traders get on a path of a process where they can focus and learn skills that they need for trading. And then this student here, he just was so kind in his words, except for this part about the old masters. I'm not sure about that. But anyway, he has really, taken the time to study these patterns and the technical analysis that I combine with it, and is doing well. So let me show you what it is here. First, I want to again tell you that I have a coupon with this. You have a $150 discount on this. So it's quite a bit. This is quite a reasonable price. Actually, the full price is the $697. The normal price is quite a reasonable price. But I know what it takes to learn trading. And I know that traders can go through course after course after course after course, and they're still confused. So my goal with this was to put together a course starting at the very beginning of the steps that you need to be able to come out understanding trading setup, have a trading setup, know how to design a trading plan for yourself and then be able to test that. These are all simplified ways to do it. They're not as complicated as some of the earlier formulas we went through, but it does take some time on your part, and it takes a commitment for you to want to study and go through it. So if you would like to get this course, and I hope that you do, this is the coupon code that you will need. And this, I believe that is going to be in capital letters. So there's, you go to my website, Trading Live Online. And from the home page, up on the top bar, there's trading courses. I'll show you my courses, but it's the Mastering Pattern Recognition. It looks like this. You click on that box. And then you go through, you just register and you sign up, put the coupon code in where it says got a coupon, then put that in and you're registered. I mentioned my weekly market setups, and I think that's important to helping you learn. And so I'll also sign you up. I will do that manually. I'll sign you up for a couple of months on my weekly market setups. That's an additional $100 bonus that you get with it. And just being on that is going to give you a lot of additional information. It's going to help you kind of put together the information that you're learning in the course. So let's go through the course and I'll show you what is included. Okay, so you're going to start with the history again. This was just an overview of the history of the fib ratios. And at the end of every section, I put in master chart tips. And this is where I take the information that I'm teaching you in these sections, and then I go to my live charts and I show you how to actually apply it on live charts. There's always a disconnect between reading or watching a video on something, and then you go to your charts and it's sort of disconnected. So I'm filling the gap for you by actually showing you how to apply those things. And then of course, you know, you can always email me from the course and ask me a question about something. I'm always happy to answer. And then we move on from there to the harmonic and repetitive swings. And this is what's happening in the markets all the time. You've got the contracting, the expansion phases. This is going to help you understand price behavior, market behavior, going to help you understand the environment that you're in for the trading tactics that you want to apply. Trending markets have different trading tactics than ranging markets do. And oops, let me go back here. There we go. And so you've got to learn the difference and be able to recognize when you're in those different market conditions. And there are price behaviors that are going to tell you when you're going in one type of condition and coming out of it into the next type of condition. The next thing that you're going to work on after understanding the building blocks with the harmonic and repetitive swings and the Fibonacci ratios is now you're going to start understanding about this trading pattern, the AB equals CD buy and sell trading pattern. And there is, even though it's a simple pattern in the shape, the lightning bolt, we go through the structure and we go through the how to draw it and label it. And you don't need the software I have to do it. You can simply do it with, if you have a Fibonacci ladder in your software, which everybody does, you just need a simple line tool and you can draw and label the patterns. But it is important to do some of this as you're starting. It's going to give you an understanding of the symmetry of the patterns. I'm going to teach you about the important characteristics of the pattern and the symmetry and asymmetry, which is important to learn. And also, as we looked at a couple examples, one large pattern can also have smaller multiple patterns within it. And there's also warning signs with these patterns that you've got to learn. And also back to the master chart tips where I go to my charts and show you all of this information, what that looks like on live charts in different markets. Once you really have that structure down, then the next patterns are the Gartley 222. This pattern is from H.M. Gartley's 1935 Profits in the Stock Market, although he never called it the Gartley 222 to buy. This is Larry Pesavento's work. He named it that from the description on page 222. So if you have that book and you go to page 222, you're not going to see Gartley referred to it as a Gartley. It was a description. Larry kind of deciphered it. So this is a great pattern. This pattern is a retest of a recent higher low with an ABCD pattern in it. Again, you'll have my master chart tips on my live charts. The powerful butterfly reversal pattern, we just looked at that. And you can see how powerful it doesn't always get those huge moves. It can fail and it can continue going in the direction. You don't get anything, but we use stops. But the potential on these patterns, and again, understanding the market environment you're in, you've got to know this pattern and more master chart tips on my live charts. And then I'm going to show you the three drive pattern, 3 ways to use the 3 drive pattern. That's in 2 parts. And then master chart tips. Now, once you've gone through all that, you have your solid foundation. Now you're ready to start developing a trade plan. This is in 2 parts. And I'm going to give you some simple metrics that you can start using in your trading. If you're not tracking your trading, you're at such risk. You don't know what's happening with the outcome. You've got to start doing this and have a trade plan. So here's your opportunity. It's not that difficult to put a trading plan together, so I help you with that. Now, trade management, this is so important. This is the engine that fuels the patterns, any pattern, not just these patterns, any pattern. So every trader has different tolerance for risk. They're on different time frames. They have different ways of managing trades. So this is what is really going to make or break you as a trader, is your trade management. And again, master chart tips on that on sections 1 and 2, give you a trade plan guide to follow. And they also get a PDF copy of my book with Larry, Essentials of Trading. It's not what you think, it's how you think. And that's more inspirational book than it is a technical book. So once again, here's what you need. If you have questions, please email me. And this is expiring on September 14th. And so this price goes back up. So I do hope you consider it. And thank you for joining me today. Everybody, I wish everyone successful trading.